So far this year, we've seen utility have outperformed the market because it offers both defense and offense. So on the defense side, when we have the market volatility caused by the macro and the geopolitical concern, utility looks favorable because they have predictable cash flows, minimal exposure to tariff, and attractive dividends. And when we see the market turns bullish, utilities are also holding up well, thanks to the continuously rising power demand from AI data centers. And we've seen utilities keep growing their data center pipelines, signed new long-term contracts with new data center customers, and raised their own capital plans and even earnings guidance accordingly. And we've seen utilities that are more exposed to this trend performed even more strongly. And another thing helped utility is the decline of 10-year Treasury yield, despite some volatility we've seen this year. And as we know, historically, they moved inversely. In the US, the rising power demand from AI data centers and the reshoring will remain the key growth drivers. We like the utilities that are well positioned to secure long-term contracts with new large load customers, expand capacity with existing customers, and address the affordability concerns. We also believe utilities that are able to meet the data center's requirement for time to power and reliability should continue to perform well. In Europe, the story could be a little bit different. So we've seen a super cycle of capital investment in the grid, and it's still in the early stage. So we like utilities that can benefit from this capex upcycle. We also like utilities that can potentially leverage their relationship with the existing data center customers to secure long-term contracts in the future, as we see that data center theme starts to play out in Europe as well. In the US, power remains one of the key constraints in the AI race, and policymakers are working to accelerate new supply and to ensure affordability for the broader customer base. Those regulatory developments can create both upside and downside risk for utilities. There are several key events to watch. First is policymakers are inclined to streamline the building of new nuclear projects. However, utilities may need additional support from government to mitigate the cost overrun and delay risk. The second thing I'll watch is the PJM capacity auction reform. PJM is the largest regional transmission organization in the US, and the PJM capacity auction ensures future grid reliability and send investment signal for power generation. Given a clear future supply and demand shortfall, PJM is actively exploring reforms to prevent the capacity price from soaring and to protect the ratepayers. So the potential reform could be bifurcated auction market for existing and new resources, requiring data centers to bring new supply or curtail load during system stress. So this would be a risk, particular for power stocks.